Who has time to read books, right? We want the juice. Here is a summary of the Bogleheads Guide to Investing, a book based on the investment philosophy of John C. Bogle, the founder of Vanguard and a pioneer of index fund investing. The book is written by a group of investors who follow Bogle's principles and is intended for investors of all levels. Stick with us to the end, and we will give you an example of how to apply these principles with live numbers. One of the key themes of the book is the importance of keeping investing simple. The authors argue that investors can achieve their goals by using low-cost index funds or exchange-traded funds, ETFs, that track broad market indexes. These funds are less expensive than actively managed mutual funds, which can have high fees and underperform the market. The book also emphasizes the importance of diversification. By spreading investments across different asset classes, such as stocks, bonds, and cash, investors can reduce their risk and improve their chances of achieving long-term goals. The authors recommend using a 3-fund portfolio that consists of a total stock market index fund, a total bond market index fund, and an international stock index fund. Another key theme of the book is the role of behavioral economics in investing. The authors argue that psychological biases can lead investors to make irrational investment decisions, such as buying high and selling low. They provide strategies for overcoming these biases, such as avoiding emotional decision-making, sticking to a long-term investment plan, and avoiding market timing. The book also explores modern portfolio theory. The authors provide guidance on asset allocation, including the appropriate mix of stocks, bonds, and cash for different investors. They also discuss the importance of rebalancing a portfolio regularly to maintain the desired asset allocation. Overall, the Bogleheads Guide to Investing provides practical advice and insights for investors of all levels. The book advocates for a simple and straightforward approach to investing that is focused on minimizing costs, diversifying investments, and sticking to a long-term strategy. By following these principles, investors can achieve their goals and build wealth over time. Here is your example. Let's say you have $10,000 to invest and you want to create a diversified portfolio of low-cost index funds. The first step is to determine your asset allocation, which is the mix of stocks and bonds in your portfolio based on your investment goals and risk tolerance. For this example, let's assume you are a 30-year-old investor with a long-term horizon and a moderate risk tolerance. A common rule of thumb for determining asset allocation is to subtract your age from 100 to determine the percentage of your portfolio that should be allocated to stocks. In this case, that would be 70%. So you would allocate $7,000 to stocks and $3,000 to bonds. Next, you would choose index funds to represent each asset class. For stocks, you might choose the Vanguard Total Stock Market Index Fund, VTSAX, which tracks the performance of the entire US stock market. For bonds, you might choose the Vanguard Total Bond Market Index Fund, VBTLX, which tracks the performance of the entire US bond market. Let's assume that VTSAX has an expense ratio of 0.04% and VBTLX has an expense ratio of 0.05%. This means that for every $10,000 you invest, you will pay $4 in fees for VTSAX and $5 for VBTLX. You would then allocate your $7,000 for stocks and $3,000 for bonds between the two funds based on your desired asset allocation. For example, you might allocate $5,000 to VTSAX and $2,000 to VBTLX for stocks and $1,500 to VBTLX and $1,500 to VBTLX for bonds. Over time, as the value of your investment grows or declines, you would periodically rebalance your portfolio to maintain your desired asset allocation. This might involve selling some of one fund and buying more of another to bring your portfolio back into balance. By following these principles, of low-cost diversified index fund investing and periodic rebalancing, you can build a simple and effective portfolio that will help you achieve your long-term investment goals. Live rich and prosper. See you on the next video.